Morphic Asset Management, I'm pleased to say, joins me in studio. Lots I want to talk to you about, James, but could we start with the trade wars, the tariffs that have been introduced? You had a white paper released by China as well to that point, saying, you know, look, we will not hold these talks whilst you basically got a gun to our head. We don't want a trade war, but we'll fight a war if we need to. How does this play out?
I think the most important thing from my perspective is the timelines here. They differ. The political cycle in the US is a lot shorter than that in China. Who knows how long that is? And to that extent, Trump's used quite a fair few bullets in his gun. He gets to 500 billion, and that's the trade balance. That's the trade with China. So it's very much in President Xi's interest to take his time, be patient.
Does he have the luxury of time? Yes, I know he's a leader for life, but there is also the unspoken social compact that the China's leaders have with the populace. That is, you basically don't have a democracy. The payoff being your quality of life will continue to improve under us. I mean, do they start to feel the pinch?
I think longer term they might do, but we see them thinking about that policy, taking that into consideration when we look at the exchange rate, for instance. When we look at the post the 10% weakening, then the lowering of tariffs on imports from everywhere else in the world other than the US is a way to mitigate that risk. And I think probably again to timelines, Trump probably has a higher probability of a policy mistake that comes down to impact on his electorate in terms of the price of your basket of goods from Walmart being a lot higher over time because of these tariffs. Clearly, the Chinese face potentially inflationary problems as well, but again on a slightly different timeline, I think, which favours the Chinese position.
It was interesting. I was talking to a portfolio manager on air a little bit earlier today that they've focused domestic equities. In particular, small caps, and they kind of like the miners at the moment because they think there is a mispricing underway there's perhaps too much concern around the outlook for global growth and so forth because of the trade wars. He thinks that those parts of the market that are complacent are getting it right, that this won't be taken to any kind of ambit inevitable end by Donald Trump, that it is the art of the deal, if you like. And yes, that has been a view in the market, but it seems those voices are getting quieter as Donald Trump seems to be very much sticking by his guns. I mean, where do you sit in terms of what he's actually doing and how far he's willing to go?
Well, the consequences of the actions of both sides will take a reasonable amount of time to impact on the economy. We're not talking next week. We're talking Q1, Q2 of next year. So there's time for both to sit back and see what the consequences are. I think it's. That's not great for a market that wants sound bites on a daily basis, wants investment opportunities on a daily basis. We see the dislocations in some sectors. Industrials with Chinese exposure, for instance, being heavily punished, discounting what may be a very significant slowdown in the Chinese economy. But again, looking for evidence, it's not immediately obvious that is the outcome in front of us.
What about looking for opportunities? I mean, so much has been made about emerging markets, and for many of them it's been more of a currency crisis outside of Chinese equities. I mean, they have very much copped the brunt, if you like. Your thoughts around uncovering opportunities whilst you've got this noise, if you like?
Well, firstly, I find it fascinating that a lot of market participants complain about a lack of volatility for many years, and as soon as volatility smacks us in the face, then there's even louder complaints. Volatility is good. It allows us to hopefully buy high quality franchises at cheaper prices in the event that sell-offs are indiscriminate. It allows us to get out of overvalued opportunities when other investors get too enthusiastic. So we always welcome volatility. It means we have to rely upon solid risk management when that volatility is against our prior judgment, and that's fine. But no, we particularly, and as global investors, we welcome it. You're referring there to, from a currency perspective, I assume, India.
Yeah.
I think this is in part tied in with where we are in the interest rate cycle. 10 years into a bull market, my suspicion is we're closer to the end than the beginning, and the Treasury market is pricing in more hikes. India per se is closer to elections than many other parts of the world. There are some specific factors in the financial system there. Some stresses in the non-banking loan market specifically. There's a particular private equity infrastructure fund that's struggling with potential default, and we see that being priced into the valuation of some of the lower quality banks in that part of the world.
You mentioned, this return to volatility. In your opinion, is this a return to normal markets? Has the last few years, do you think, been the exception, the aberration, where you've had next to no volatility? And if you think that, does this then swing the momentum or swing favour back to the stock picker? Does it swing it back to the active manager as opposed to what has been an enormous, gigantic rise, if you like, of passive investing, which has been very good in low vol times?
I think that's a very convenient narrative for an active fund manager to roll out. I'm not sure that I subscribe to that entirely. At the end of the day, volatility is a functional, the many ways it's measured is a function of interest rates, and if interest rates are lower, volatility mathematically can be lower. I think it comes down to your time horizon. I remember days of European equity markets where 2-3% moves in either direction were not uncommon. That just reflects the greyness of my hair. There'll be others that for whom have entered the market in the last 7 to 10 years for whom this will be a shock to the system. But I say get used to it.
How do you then go about, and this is quite particular to Morphic, but something we've seen in the last few years, certainly a rising constituency within the market of doing investments through the lens of ethical investing? Just firstly, it sounds obvious, but just explain what that actually means, and then we'll sort of get into the nitty-gritty a little bit more.
Well, the history of ethical investing was simply a question of mirroring the values of your clients in where you invested. So, from a religious perspective or a moral perspective, just avoiding certain industries. That manifested itself in what are referred to as negative screens. So basically saying there are certain sectors, certain types of companies, be it arms manufacturers, tobacco companies, alcohol companies, which simply our investors do not want to be invested in, and thus, as investors on their behalf, we will not touch. And that's
who makes that call? Who makes that judgment? What if you have a handful? You have whatever sample size of investors, clients. And some say, look, we want nothing to do with. I'll just pick someone. We want nothing to do with Woolworths. Yeah, everyone knows them as a supermarket, but they also own the most poker machines and hotels, whatever in Australia. But you have another, perhaps equally large investor base. We're okay with Woolworths. Who then makes? Is it the PM that makes the decision? Right, we strike them. They're in or they're out.
Well, it's defined in the terms of reference, the documentation behind a particular product, and it's a hard and fast set of rules, and one hopes it reflects the values of your clients. Now,
majority.
For many people, just saying no is where the ethicalness of the process stops. For us, that's just the very beginning, because saying that a company, just because a company doesn't fall into a particularly bad sector, means it's okay to invest in, I think opens a lot of those fund managers and also their clients to being exposed without really knowing to some of those bad areas. And Woolies is a classic example. I can't think of a negative screen that would fail, or a simplistic one. It's only when you look into it and see the exposure to gambling, pokers, to alcohol distribution, that a few alarm bells should ring. And for many processes, the ethics have finished before that realisation is upon the fund manager. For us, that's where the hard work starts, and that's where the due diligence that goes into identifying the materiality of any environmental, social and governance risks. ESG, many might have heard of that term. That's where the hard work starts. And it's beyond then. It's then through engaging with the companies.
So let's talk about that. So it's interesting to note, look, activists share, people talk over the last couple of years like it's some new phenomenon here in Australia. I mean, there's been activist investors in Australia for quite some time. Perhaps there's the new, somewhat more aggressive style that we've seen in the US. Perhaps we're seeing a little bit more of that. What about on the ethical side? I mean, do you look to go beyond saying here is a group of company sectors we won't go into? Does it move beyond that to where you say, actually, why don't we start considering ourselves potentially an agent of change, if you like, within some of these sectors and companies?
And that's exactly the case. There's a growing body of investors and other stakeholders supporting industry bodies such as the Responsible Investment Association of Australasia and PRI, which is the broader global industry body, whereby we're signing up to a broader set of responsibilities beyond just fiduciary duty, which is the best performance, and that's committing to engage with companies, talking to them. To sometimes it's discovery, sometimes it's discovering that they aren't behaving in the best manner. But that's two-way. We can then act as agents of change to push a more holistic agenda. So this is investment of a more holistic nature. It's the best returns, but we believe over the long term, those companies that behave in the best way, be it from an environmental, social or governance perspective, will actually deliver the best investment returns for shareholders over the long term.
Over the long term. And just finally, James, what about the increasing awareness of it and I suppose from an investment perspective, attraction towards it? I mean, is the growth there? Is the market there for those people who want to be attach that holistic view, if you like, as you mentioned?
Absolutely. A recent piece from one of the industry bodies suggested that more than 50% of assets under professional management here in Australia incorporate some consideration. Now, there's degrees of it, there's degrees of. There's the thought process finishing at the negative screen, and there's the full integration like ourselves at Morphic. But the demand is growing, and that's globally. So there's no going back.
All right, James Tayler, enjoyed our chat. Thank you very much.
Thank you.
Head of Research there at Morphic Asset Management. We need to take a break. When we